Welcome to The Explainer. Today, we're diving into a massive battle that's happening right now for control of the world's financial markets. And this isn't some slow-moving war. It's a conflict being fought in microseconds. We're talking about human instinct versus artificial intelligence. So who should be managing our money, human instinct or AI logic? And look, this isn't some far-off sci-fi question. This is happening right now, and it affects billions, literally billions of dollars in retirement funds and savings accounts. And you know the answer? It's way more complicated than you'd think. All right, first up, in this corner, we've got the reigning champ, the traditional human fund manager. These are the folks who build their entire strategy on years of experience, on gut feelings, on what you might call qualitative judgment. So what's their superpower? It's all about context. A human manager can, read the room. They can pick up on the subtle tone of a policy announcement or just feel when investor mood is starting to shift. An algorithm? Well, it's just trained on what's happened in the past. So when something totally new and unexpected happens, it can really get thrown for a loop.
But, and this is a big but, what happens when our own psychology gets in the way? There's this whole field of study called behavioral finance, and it's shown pretty conclusively that our emotions are often the absolute worst enemy of a healthy portfolio.
Okay, let's talk about loss aversion. This is a huge one. It's this cognitive bias where, psychologically, the pain of losing something feels about twice as strong as the pleasure of gaining the same amount. So think about it. This bias can make a manager irrationally cling to a losing stock, just hoping and praying it'll recover, even when every rational signal is screaming, sell. And then, of course, there's herd behavior. You know the feeling, right? It just feels safer to do what everyone else is doing. But in the world of investing, following the crowd can be a disaster. It's exactly what inflates those crazy market bubbles, and it's what causes mass panic selling when things start to dip. All right, so now let's meet the challenger. This is a totally different beast, a tireless, data-driven force that runs 24/7 on nothing but pure, cold logic. It doesn't feel fear, it doesn't feel greed, it's all about probability. And don't get it twisted, the machines are already a dominant force. I mean, just look at the Forex market, the foreign exchange market. By some estimates, algorithms are responsible for something like 92% of the trading there. That's staggering. So how did we get here? Well, this whole thing didn't just pop up overnight. It really started back in the 70s with some basic electronic order systems. But the real game changer came in 2001 with something called decimalization. Basically, instead of pricing stocks in clunky fractions, markets switched to pennies. Suddenly, there were all these tiny little profit opportunities, but you had to be incredibly fast to catch them. And that lit a fire under high-frequency trading, which now accounts for more than half of all U.S. equity volume. It's wild. So how do these AIs actually decide what to do? Well, first, they analyze just a mind-boggling amount of data. We're talking financial reports, news, even social media chatter. Then, they use that info to spot these incredibly complex patterns and trends that are completely invisible to the human eye. And finally, they just execute the trade, all based on probability without an ounce of human emotion getting in the way. All right, this is it, the main event. You've got the seasoned human manager on one side and the lightning-fast algorithm on the other. So, when the bell rings and they go head-to-head, who actually wins? Well, researchers really wanted to find out. A big study published in 2024 took a hard look at fund performance, especially during all the crazy market swings we saw, to try and settle this debate once and for all. And the results were fascinating. Turns out it really depends on the market. In a sustained bull market, when everything's going up, human managers are great. They use their intuition to really ride that wave of positive feeling and capture those gains. But when the market takes a nosedive, the AI managers really shine. They use pure data to manage risk and protect you from big losses, because there's no emotion involved. And this isn't just a one-off finding. Study after study shows the same thing. One from 2020 highlighted how AI is great at downside protection in unstable markets. Another, even going back to 1998, pointed out that human managers, well, they tend to get overconfident and trade too much, which can really eat into your returns. But hold on, it's not all sunshine and rainbows for the machines. This rise of the algorithms, it's got a dark side, a really risky side that can actually put the whole financial system in jeopardy. Yeah, there's this great quote from Andrew Lo at MIT who calls it a technological arms race. And he's spot on. you have firms spending fortunes to get just a few microseconds of an advantage over the competition. It's absolutely relentless. And this high-speed race brings some serious dangers. There's what they call the black box problem, where these AIs get so complex that even their programmers don't fully understand why they make certain decisions. Then there's the very real potential for market manipulation using these algorithms. And maybe the scariest one? A single tiny glitch in the software can set off a catastrophic chain reaction in the blink of an eye. And this isn't just theory, okay? It's happened. Back in 2012, Knight Capital Group lost a staggering $440 million in 45 minutes, all because of a software glitch. It nearly wiped out the entire firm.
And these individual glitches can have a ripple effect on the whole market. Remember the 2010 flash crash? The Dow plunged almost 1,000 points in just minutes. A big part of the reason was that all these algorithms started pulling out of the market at the same time, creating this vacuum that just sucked prices down.
So where does that leave us? What's the final verdict? Is it the flawed, emotional human, or the cold but potentially dangerous machine?
Well, it turns out the best approach isn't man or machine. It's man and machine. The research is pretty clear on this. There's no knockout winner. The future is all about a new kind of team.
People are moving towards these hybrid models. The idea is simple. You integrate the best of both worlds. You let the AI do the heavy lifting, crunching the data, managing risk, executing trades with insane precision. But you have a human expert providing that final oversight, that strategic vision, and that all-important contextual judgment that, for now, machines just don't have. And that leaves us with a really big, provocative question for the future. Right now, this human-machine partnership seems like the perfect solution. But as AI gets more and more powerful, exponentially more powerful, will there always be a need for a human in the loop? That's the billion-dollar question, isn't it?